Before I delve into the greatest financial bubbles in history, let's first understand what a financial bubble is. A financial bubble is a situation in any market where asset prices reach unjustifiably high levels, followed by a global collapse. There are no specific quantitative criteria to determine when a financial bubble occurs. Distinguishing it from the regular growth of quotes against the backdrop of economic development is challenging. The realization that it was indeed a financial bubble often only comes after it has burst. Alan Greenspan, former chairman of the Federal Reserve, writes in his book, The Age of Turbulence, that if the stock market falls by 30 to 40% within a few weeks or months, it indicates the presence of a bubble. Bubbles can occur in any market except for consumer goods, because the latter are usually purchased for personal use, and they are rarely resold, making speculation challenging due to low liquidity. Spanish scholar Carlota Perez, who studies the connection between technology and economic development, writes in her book, Technological Revolutions and Financial Capital, that approximately every 50 years, an economic cycle consisting of 4 phases repeats itself: installation, eruption, synergy, and maturity. Financial bubbles are a natural part of the eruption phase. Based on the extent of market coverage, bubbles are divided into macro and micro. Macro bubbles encompass several economic sectors, such as real estate and the stock market, affecting the economies of entire countries or even the world. Micro bubbles do not impact the overall economy and only cover specific sectors and companies. For example, in 1983, stocks of technology companies like Apple and Micron collapsed by 80%. During micromanias, the prices of companies that had experienced significant growth earlier decline, but they typically recover quite quickly. Bubbles can also be classified based on human behavior as rational or irrational. During rational bubbles, investors are aware that assets are overvalued, but they are willing to pay, hoping to sell them before the bubble bursts. Rational bubbles typically occur in specific markets where asset valuation is challenging, such as in the art market. In irrational bubbles, investors are unaware that assets are overvalued. They believe that prices will continue to rise indefinitely and often buy at peak levels. Irrational bubbles are closely tied to psychology, which is why they are also referred to as speculative. Commission and intrinsic bubbles are additional distinctions. Commission bubbles form because investors and portfolio managers have different motivations. Portfolio managers do not incur costs if their clients incur losses, but they receive rewards for success. Therefore, they may invest in high-risk instruments and speculate, inflating bubbles. Additionally, managers earn commissions on transactions and are interested in increasing their quantity. Intrinsic bubbles arise when a company's value increases due to the size of dividends. For example, based on financial data, Exxon borrows money to pay dividends. In 2020, they raised $15 billion, and these funds ran out, even though they did not initiate any new projects. This type of bubble can usually be recognized by the payout ratio parameter, the percentage of profits that a company directs towards shareholder payouts. If it exceeds 100% for several quarters, it means the company is accumulating debts to sustain dividend payments. For example, as of the first quarter of 2021, Exxon's payout ratio was 136.25%. How do you think bubbles affect the economy? We'll present a few theses, and if you agree or have a different opinion, please share it with us in the comments on this video. Analysts typically highlight the negative impact of bubbles. The economy overheats, with too much money flowing into certain sectors, while others face difficulties. In the long term, this leads to a loss of prosperity. Firstly, liquidity decreases. At the peak of the bubble, it's challenging to sell assets without a price loss. Once investors start cashing in profits en masse, prices sharply decline, and the bubble bursts. Secondly, money becomes more expensive because central banks and the Federal Reserve raise key interest rates. The amount of so-called bad debt increases, collateral values decrease, and banks also raise interest rates. This leads to an economic crisis or even a prolonged recession. Not all bubbles lead to economic crises. Large bubbles that encompass many sectors of the economy can lead to a crisis, while local bubbles, for example, in a particular security, probably do not. However, if the bubble involves systemically important companies, it can trigger a cascade of bankruptcies, layoffs, and financial losses, as was the case with Lehman Brothers in 2008. Many financial institutions, banks, and brokers were adversely affected. Certainly, the standard of living and prosperity decline. The collapse of bubbles leads to a chain of bankruptcies, a crisis, a rise in unemployment, as seen after the 2008 mortgage bubble. The capital of private and institutional investors decreases. The value of assets held by pension funds decreases, leading to potential problems with pension payouts. If you remember 2008, share in the comments how the crisis affected you or your family. However, bubbles have positive aspects. Bubbles can be indicative of technological development. Often, innovative inventions such as railways, bicycles, cars, and the internet led to the formation of bubbles. New technologies are difficult to assess, so investors attach excessive expectations to them. Another positive aspect is that technologies reach people faster because a lot of money flows into new industries, and they grow very quickly. Inflation hardly increases because markets easily absorb all the money printed by the government. Investors can make decent profits from bubbles, but of course, not everyone. Now that we've delved into what financial bubbles are and their significance for society, let's learn about the greatest bubbles in history. Tulip Mania of 1637. If we had to choose the greatest bubble in history based on how speculative it was, the Tulip Mania of 1637 would be the absolute leader. In no other bubble in history was an object of such low utility, namely a flower, sold at such a high price. This incident took place in the Netherlands in the 17th century and was incidentally the first documented bubble. In the 17th century, the Dutch-Spanish Wars came to an end, and the country transitioned from economic decline to prosperity. With the largest fleet at the time, the Netherlands actively traded with the East Indies and Japan, resulting in an influx of wealth. Additionally, due to the bubonic plague, many people died, leading to a shortage of labor. The remaining workers demanded higher wages, injecting money into the hands of ordinary people. The fascination with tulips began as collecting and cultivating beautiful flowers. However, occasionally, due to a virus causing variegated leaves, exotic colored flowers appeared. They bloomed for a short time and produced fewer bulbs. These varieties were called broken tulips and were the most highly valued on the market because they were in short supply. For instance, in 1636, one bulb of the Semper Augustus variety was sold for 3,000 guilders. To put this into perspective, with the same amount of money at the time, one could buy 6 boats or 300 sheep. Since the outcome of a bulb could not be determined until it grew into a flower, initially, only knowledgeable individuals traded them, and only from spring to autumn. However, speculators emerged, buying bulbs for resale. Trading by weight began, and the first futures and options contracts appeared. Bulbs were sold in winter when they were physically in the ground. Poor people also joined forces to buy tulip shares. Experienced florists deceived newcomers by passing off cheap bulbs as expensive varieties, taking payment in the form of clothing, furniture, or livestock. Tulip prices also rose because buyers did not have to pay up front. They paid a small commission to the seller and could choose not to purchase the tulips if they were dissatisfied with the prices. These were essentially option contracts. When prices stopped rising, there were fewer buyers interested in tulips, leading to a sharp collapse in prices. South Sea Bubble of 1720. This bubble is not often discussed because it did not have a broad economic impact. However, it is notable as one of the earliest examples of an extremely unsuccessful IPO. The brief history of this bubble is as follows. In 1711, the South Sea Company was established in England. Shareholders were promised exclusive trading rights for slaves in the Spanish part of South America. The company began its commercial activities only in 1717. In 1720, the share price started to rise rapidly, from £128 in January to £1,000 in August. Frenzy gripped all of England, from peasants to lords. Everyone was buying shares in the company. However, it soon became clear that the company's management had greatly exaggerated its profit forecasts. In September, a sharp decline in stock prices began. By the end of September, the share price had fallen to £150, and on September 24th, the company declared bankruptcy. Thousands of investors were ruined, including many well-known individuals. Sir Isaac Newton, for example, lost over £20,000 in the company's collapse, equivalent to £3.5 million in 2023, after which he remarked that he could calculate the motion of celestial bodies, but not the madness of the crowd. Railway Mania of 1846. The first steam locomotive appeared in the early 19th century, but society was hesitant to embrace this innovation, suspecting it of foul play and fearing the noise and speed. However, skepticism was eventually overcome. In 1825, the first railway line was built, and in the same year, Parliament issued patents for 6 more lines. When the line between Manchester and Liverpool opened, shares of the owning company doubled. By the end of the 1830s, there were about 2,000 miles of railways in the country, with several branches connecting different cities. However, the mania only set in during the 1840s when the cost of railway construction dropped, and doubts about their great future disappeared. By 1845, plans were in place to build 8,000 miles of railways. Instead of company shares, scrips, certificates for shares, were issued, which soon became a separate instrument. Speculative demand drove prices up to 500% of their initial value, and banks provided loans secured by shares with interest rates of up to 80%. Everyone expected a crash, but hoped not to be the last in the chain of speculation. Ultimately, the bubble burst when the central bank raised the key interest rate, and a stream of speculative money left the industry. To build the planned branches, companies began demanding additional shareholder capital, but this dealt a painful blow to other sectors of the economy. In the end, Parliament issued an order to cease railway construction. Many projects remained unrealized. Florida boom of the 1920s. In the late 19th century, oil magnate and John D. Rockefeller's partner, Henry Flagler, embarked on transforming Florida into a resort destination. He started building hotels, acquiring railway branches, constructing new ones, and connecting them into a network. One of the new stations was in a village that became modern-day Miami. At the beginning of the 20th century, the popularity of the new resort grew among the wealthier segment of society, which due to World War I, couldn't vacation on the French Riviera. The drainage of the Everglades, which occupied a significant part of the state, also contributed to development. The land here became accessible to less affluent people. Only in January 1926, real estate transactions in the area amounted to $2 billion. Most projects were sold at the planning stage, often without showing the plots to buyers, and sometimes even indicating their location approximately. Real estate firms then began trading lots, and they could be purchased on credit. The buyer received a receipt for the deposit, giving the right to purchase the plot, but not obligating them to buy it. As a result, speculators with advance payment receipts for land purchases emerged. Cases where a lot changed hands a dozen times before closing the deal were not uncommon. Those who couldn't come in person were offered to buy real estate remotely by simply sending a check. The peak of the Florida boom is considered May 1925, and the record deal was the sale of plots ranging from $6.5 million to $30.6 million per acre. But one day everything changed abruptly. Americans started vacationing in Europe again, and sales came to a halt. Those who bought plots for $20,000 and expected to resell them for $30,000 suddenly realized they were being offered $18,000 or even $15,000. By September 1926, prices in Miami had fallen by about a third from the peak level, and then the coast was hit by a destructive hurricane. Japanese financial bubble. In the second half of the 20th century, Japan experienced powerful economic growth. By the early 1980s, the country was perceived as a new global leader thanks to its technological exports, while the United States was in decline. Japan was in a state of euphoria. The value of real estate and stocks was rapidly rising. In the mid-1980s, the United States, Japan, Germany, France, and the United Kingdom agreed to regulate the exchange rates of their national currencies against the dollar to maintain the balance of international trade. As a result, the yen strengthened against the dollar, slowing down exports and economic growth. In response, the Bank of Japan began to lower its key interest rate. Within a year, it was halved from 5% to 2.5%. The cheaper money flooded the market, and the growth of real estate and stock prices accelerated, accompanied by speculative demand. The Nikkei 225 index from 1985 to 1989 grew fourfold. Real estate prices were also rising. By the end of the 1980s, a 75-square-meter apartment, an hour-and-a-half drive from the center of Tokyo, would cost more than 8 times the average annual salary of an office worker. When by the end of the 1980s, rising prices became threatening, the authorities restricted lending and sharply raised the key interest rate to 6% in 1990. At the same time, demand for Japan's export products fell in Europe and the United States. With no faith in continuous price growth, speculative demand disappeared, and the bubble burst. The chain reaction led to a phenomenon known as the lost decades. Companies lost sources of financing and reduced investments. Banks froze lending and consumer spending declined. Dot-com bubble. The 1990s were a period of the dot-com boom, referring to online companies that emerged during that time. The rapid growth of eBay, Yahoo, and Amazon fueled interest in the internet. Companies were creating websites, and society was becoming increasingly enthusiastic about the new possibilities opened up by the global connectivity of the information network. A flow of investments flooded into this sector. Startups that hadn't started making profits yet redirected the raised funds towards marketing to generate interest and attract even more capital. As a result, the market capitalization of companies skyrocketed, and many of them were overvalued. From 1995 to 2000, the Nasdaq Technology Index grew fourfold. In 2001, investors began losing faith in dot-coms. Major players realized that the market was at its peak, but inflated capitalizations were not supported by real business opportunities. They started selling shares of internet companies, and this trend was followed by broad masses of investors. In 2002, the Nasdaq index collapsed by 78%, losing about $5 trillion in market capitalization. Mortgage crisis. One of the most well-known economic bubbles led to a financial crisis in the United States, which escalated into a global economic downturn. In the early 2000s, the U.S. real estate market experienced a boom. Demand was fueled by accessible mortgage programs. Meanwhile, real estate prices were rising and banks could easily sell homes of insolvent borrowers in extreme cases. To attract new capital, banks issued mortgage-backed securities based on future income. The funds received from investment funds were then reissued to borrowers. Over time, the number of credit-worthy borrowers diminished, and to maintain the scale of lending, requirements for them were eased. The share of high-risk loans increased, and a significant portion had floating interest rates. By 2006, the real estate market was saturated, and prices started to fall. Loan interest rates were rising, and refinancing became more difficult. As a result, in 2007, the number of delinquencies skyrocketed. Many people were evicted from their homes, but banks could no longer cover losses by selling the homes of debtors. Simultaneously, the market for mortgage-backed securities collapsed. This was followed by a series of high-profile bankruptcies of financial institutions, including the collapse of one of the world's largest investment banks, Lehman Brothers. In 2008 to 2009, the crisis spread to other industries and countries, ultimately leading to a global decrease in demand and production. Well, there you have it. We've now learned about the greatest financial bubbles in history. Only time will tell when and where the next financial bubble will burst and what consequences it will have on the world. If you enjoyed this video, subscribe to the channel, hit the like button, and share the video with your friends.